Good afternoon, everybody. Welcome to the TraderMerlin Show. It is your Tuesday edition, an eventful day, and hopefully I didn't screw up today as I did with Ryan Watkins the other day where I didn't get my audio set up for my guest properly. We'll find out here momentarily. As some of you may have seen last night, there was some wild moves in the Japanese yen and the US dollar, sending the dollar plummeting and the yen soaring. And that has to do a lot with interest rates. So I know a bit about bonds, but I am nowhere near the level of proficiency that my guest is, who is joining us today. I believe he's on the East Coast today. I never actually know exactly where he's at. We've got Mr. Bill Addiss joining us. Bill, how you doing, my friend?
I'm great, Merlin. Beautiful Washington, D.C. The nation's swamp is where I am today.
The nation's swamp. That just doesn't sound very good. The good news is I have your audio fixed and everything sounds great, so I'm excited about that.
Wonderful. Pleasure to be here. Thank you for the opportunity.
Oh, hey, I love having you on because not only do I learn things, but my guests always learn some stuff as well, and you have a pretty good following here. So let us, I'm going to go through and read this question to you real quick, just so we set the basis for our initial discussion, which is talking about, of course, the Japanese yen. And the question came in from Les. Les, thank you very much for being the first one into the room almost every day and always commenting on my YouTube videos. I appreciate that. For anybody who might be new, comment on the YouTube videos. That will steer the show's topics. You can do it on any video at TraderMerlin on YouTube. Les says, with the Bank of Japan overnight, what exactly did they do and what does it mean? How does their action or lack thereof affect how the markets and currency move? So let us dive into that a little bit here because I did a Monday morning must-knows for Online Trading Academy and I said, listen, Japan's kept their rates at negative 0.1 for so long, it's about time that we might start to see some change. I don't know if it's going to happen at their next meeting, but there might be some changes afoot. And lo and behold, boom, we got smacked in the face with an announcement last night. Tell us what it is and what does it mean?
Great. And great question from your audience. You always get great questions. To answer the question, I got to take a bit of a step back and address the global issue of what we've been talking about all year about stagflation, right? Where we've had the central banks throughout the world have decided this year that inflation is a problem, and they've been raising short-term interest rates, and they've started doing tapering, which is destroying of money. And we've been talking about this being a global phenomenon. Well, the truth is it hasn't been a truly global phenomenon because the Japanese economy has not been suffering that same problem. The Japanese economy is not coming out of the pandemic well, but the good news is they also don't have inflation problems. Mm-hmm. So what's happened over the last year is most every central bank in the world, and we saw it again last week, have raised short-term interest rates. Japan hasn't done that. And in fact, they actually did the experiment, you might remember, when all the countries brought down their rates during the pandemic, when we brought our Fed funds rate down to zero. Yep. Japan tried the experiment, they and Germany, tried the experiment of doing a negative interbank rate. And that's where the rates are still today. Yeah. They're still negative at the short end of the market. I think you've got a picture of the yield curve showing that.
Here's the actual announcements from the Bank of Japan. It's weird because when you look at this type of chart, you normally see fluctuations. This goes back to 2016, the chart I'm looking at, and they haven't changed anything. It has literally been stuck at negative 0.1 for the last 6 years, and I could probably go back longer. And to Bill's point, I'll bring up the yield curve for everybody so you can see this one. Let me fast forward here through the yield curve real quick. Let's go to the Japanese yield curve. That was one of the last slides you sent me. Here's the Japanese yield curve, and you can see on the left-hand side of that chart, we're negative, right? We're under zero, and the little dotted line here is where we were 6 months ago. Where were we?
It's a 6 month time frame, yeah.
Right, 6 months ago, and then today we popped up even higher than this. So this yield curve is illustrating to us what, that they're letting that long end of the longer term maturities rise.
Well, but first off, let's stay with the short end for just a moment. Then we'll work out long. So in the short end, they haven't touched interest rates in the last 6 months, or let alone the last 6 years.
Right.
Whereas the rest of the world's been raising short term rates. Japan has said we have no need to. But where we now focus is in the long end, because what Japan has also been doing for the last year, unlike the rest of the world, is they've still been engaged in quantitative easing. They're printing up money, and they're using that money specifically to target and buy the 10-year Japanese government bond, JGB. And what the Japanese government's, pardon me, not the Japanese government, what the Bank of Japan said 2 years ago was, we want the 10-year treasury in Japan to yield zero. but we're willing to give it 25 basis points up or down. We'll give it some leeway. So what the Bank of Japan has been doing is, as interest rates in Japan have wanted to rise, what the Bank of Japan has been doing is they've been printing up money and using that money to buy the 10-year JGB, driving up the price and down the yield.
Right.
So it's direct yield curve manipulation, and they've been printing up money, doing QE to do that. Well, the announcement last night, which caught us by surprise, is after targeting that 10-year treasury at 0 with a 25 basis point latitude, they announced, much to everyone's surprise, they're now going to go to 50 basis points latitude, meaning they're going to let long-term interest rates rise without them interceding by going in and printing more money and buying more bonds. So the fact that they're basically cutting back on their QE, they're still printing yen, but they're not doing it at the rate they were. That caught the market by surprise. And as a result, we showed the Japanese currency up by, I think about 4.6% at one point against the dollar. The other real change, though, was in interest rates in Japan, because by the Japanese bank saying, we're not going to intercede as directly, literally instantaneously overnight, we saw that 10-year Japanese yield go from 0.25 up to 0.46. I mean, it went up by 21 basis points after not having moved for years.
Right.
And it came down a little bit. That was a market overreaction. I think we're somewhere in the middle there now. But this is causing strength to the Japanese yen because the yen has been super weak.
Yeah.
When the yen Bank of Japan was printing up all this yen at a time when we were destroying dollars, doing tapering. The yen to dollar at one point was 145.
It was 152.
152. I'm sorry, you're right. And that's when the Bank of Japan, probably the Japanese government, felt necessary to come in and intercede and start supporting the yen.
Yeah. It's funny, Bill, we were talking about on this show specifically saying, hey, listen, when we were up at that 152 mark, and I've got the chart here of the USD JPY, which, again, this is just an unbelievable chart for anybody who may not be familiar with currencies. I mean, this is a monumental move for a currency. You normally don't see it that dramatic. Back here in September and October, we were talking about it going, man, this thing just keeps going and going. At some point, they're going to have to step in and do something, because you can't let your currency just get so devalued that it's, just worthless currency. And that's what it was back at 150, not worthless, but 152. We've gone from 152, now we're sub 131 right now, so 132, fallen $20. So your purchasing power has died a bit for that US dollar. Again, you can probably still get a good deal to go to Japan, but this is obviously a major change of overall trend. And I have to ask you, does this reek of, I don't know, we talk about free markets, we talk about things, especially here in the US, where our Fed manipulates the short end of the yield curve and lets the longer end do what it needs to do. Yes, they can gently manipulate it, but if we look at this here, this is the graphic I showed you earlier, which is really the bands around that 10-year. And they're basically saying that they had a 25 basis points above or below 0 where that could fluctuate. And they just recently removed that. And you can see that going all the way back to early 2022, prices did not get above 25 basis points for that 10-year bond in Japan. Well, as soon as that thing was lifted, you saw a huge spike up. And to what extent do we learn from this? Because the U.S. is not doing this. We're not seeing straight manipulation there is manipulation, but not to the extent that Japan is doing. Is this a central banks around the world sitting back with eating their popcorn and having a beer, watching this, going, let's see if this crap explodes on them?
Yes.
Yeah.
As a matter of fact, it is. It really is. Because there's two things that this is a great illustration of. Number one is how the policies of the central bank can be at odds with the policy of the government.
Right.
Here we had the situation, the central bank is just printing up yen and dumping them into the market, devaluing the yen to the point that the government felt necessary to step in and intercede. I mean, this is a perfect illustration that the two can be kind of juxtapositioned against each other. But to your point on the novelty of what they're doing, this is going to be an economic lesson that we're all going to debrief as time goes on, because Japan, I'll give them credit. They took a leading edge on the bringing of the interest rates down negative. The jury's still out as to whether that's really provided anything for all the problems that it caused. Remember the negative interest rate environment and all the problems?
Yep.
Did they really gain anything by going to a negative 10 basis points? The jury's still out on that.
Well, they haven't gotten inflation. I guess you could say if you step back into the
You're
case
right.
study of it, what they did should in theory cause tremendous inflation. And
Yep.
it's not. And as someone who studied Keynesian economics in college, you're sitting there scratching your head going, well, wait a minute. This textbook right here by, Schuster and Smith says that this is supposed to cause inflation. And as Dave says here, maybe even potentially hyperinflation.
Right.
Their inflation's under control and the rest of the world is suffering. So maybe our textbooks need to be rewritten.
And that is a perfect comment that needs to be made, because that is potentially true. I mean, you also have to look, though, exacerbating that argument even more. Think about it. Japan's an island.
Yeah.
At the time when we got supply chain problems, UK's problem is they're an island. Japan's also an island. I would also, though, have to quickly point out that Japan has an energy independence, thanks to nuclear, that the rest of the world doesn't have. And that's a big factor.
Yeah, well, Japan is, an exporter of great technologies, and the UK makes a great curry.
Right. There you go. Honest but brutal.
No, I mean it's interesting. Just when you step back and look at the macro picture and how different economies produce different goods and services, and then how their currencies are manipulated. I mean, it's the most. I guess it's like a 20-dimensional chess game, right? You've got a 2D chessboard, but there's so many different dimensions how all this stuff is working, interacting. When I look at this move that happened out there today, it was actually kind of surprising. So for those of you following the markets, check out the dollar index. Dollar index was selling off pretty aggressively today, and the dollar against the yen fell about 3.8% at the end of the day numbers. When we look at this dollar index, I was actually expecting these markets to rally today because a really weak dollar generally translates into a strong equity market. We didn't get that. I think that there's still just so much looming fear about recession, et cetera, going forward. But keep your eyes on this dollar index. Now that Japan is potentially saying, hey, we'll let rates go up a little bit, that's going to start to take a little bit of luster out of that dollar. And this downtrend may continue on here. And we've got some decent demand levels down around 101, right now at about 103.9 on that dollar index. So I love this game.
Well, you're right. All currency is relative, right?
Yep.
And if everybody's raising rates, we're all going up. It's appears unchanged. Rising tide lifts all boats.
So they say.
Everybody's raising rates.
Let's see. One quick question says, Dave says, earlier Bill said that could cause inflation. What about hyperinflation, right? With the amount of printing of money that the Bank of Japan has been doing, what is the prospect for a hyperinflationary environment?
Well, I've stressed all along with my receding hairline and white hair, I still have remembrances of stagflation from 1979 and 80 in the Paul Volcker days. So I fear inflation. I make no bones about it. In 1976, the inflation rate here in the US was like 6.7%. By 1980, we were up to 14% on our way to 20. So inflation can spike quickly. We know that. And we've talked about it. The amount of money in the US economy continues to frighten me. I'm a Keynesian like you are, Merlin. I see money supply exploding the way it is. I got to worry about inflation. And having lived through 1979, and then the stagflation issues, I think I'm well advised to be cautionary.
Yeah, I can't say as I blame you. I just, when you look at these charts, it's one of those things where you got to question the old mantra that, history is a great teacher. And what do we learn from the past, and how might that sway our markets going forward? I don't know. Today, while it wasn't overly shocking, it's kind of like, I feel like saying about time, Japan. It's a good news.
Right.
You finally did something, because you've done nothing for so long. And I've been making the point, they're the last ones to really start to do anything with regards to raising rates. You had even the Swiss National Bank. They were at negative 75 basis points, and now they're raising aggressively. Japan's one of the few negative ones out there, and at some point they're going to have to go, okay, we got to stop this because we're just killing our currency. But
literally at this point, the only one left. Literally the only one left. Yep.
The only one that's important, I would say. There might be some other ones out there that are third world. I don't know anything about them, but I don't know.
On the radar screen.
The Iraqi dinar or something like that. But even that's
pegged to the dollar. The dinar's pegged.
That's true. That is. See, I can't even come up with a good example. Let's and you guys have more questions about Japan, let us know. It's interesting knowing what happened there and what the impacts might be. But just to me, it's important to know that Japan is now, it feels like they're standing up. They've been sitting down forever. Now they're standing up, saying, okay, we're monitoring the situation, which means you could see more announcements from them going forward at upcoming meetings with regards to their policy and what they may be doing.
The general market buzz you're probably hearing too from the talking heads is, okay, now that they've addressed the long end and what they're doing with the 10-year, the next movement is going to be on the short end to bring that rate up below zero, from the negative rate. That's the expectation of the market.
Absolutely. So talking about the 10-year, you mentioned before I had to cancel my shows last week with you because I was not feeling so well, that the 10-year bond auction for the U.S., you said it was really bad, not looking good. Well, walk us through a little bit about what happened last week with that 10-year bond auction, and then we'll dive into Jerome Powell.
Yeah, the beauty, for the audience to reiterate, the bond market is over the counter. So you never know who's actually in buying, where the liquidity is, who's doing what, because it's a completely over the counter market here in the US. There is no exchange trading. So when the government does the treasury auctions, we get a nice snapshot of who the buyers are and what's the level of participation. So, how much is the Fed in buying? They disclose that. How much are foreign central banks buying? That gets disclosed. How much do our dealers wind up buying because they don't have orders from the customers, but they have to step up to the plate and buy them? So the auctions are a real nice snapshot, and then we can get a comparison. And, we've talked about, the US government is the largest borrower of money in the world because we have the greatest deficit in the world. But the good news, at least, is we have a lot of buyers in the world who want to buy our bonds. And looking at the 10-year auction, we're going up to this year, we had on average about 2.6 times more buy orders than we actually had treasuries to sell. So if we were selling $10 billion in treasuries, we had $26 billion in orders,
right?
Because we can add them, we can count them. And that's called the bid to cover ratio. So we enjoy a lot of global investors who want to buy our bonds. And it all comes down to supply and demand. I mean, I know the OT community is very comfortable with supply and demand. We've got one of the largest supplies of bonds in the world coming to market. Good news is, though, demand has been strong. Unfortunately, though, I have to be a little bit negative. That demand is starting to lessen. We are seeing a dramatic lack of participation in the participants who normally buy our treasuries. And what it means is the dealers, we've got 24 dealers here in the US who have to buy these treasuries. They're wind up owning them all. The central banks aren't buying them. The large insurance companies aren't buying them. And as a result, the dealers will wind up getting stuck with a lot of bonds. And what does that mean? At the next auction, they're not going to be so quick to want to buy any more because they're already sitting on boatloads.
Yeah, what did you say happened with the bid to cover ratio?
Before this year, we were averaging about 2.63 as our bid to cover ratio. And we've had auctions this year below 2.5%. That's starting to concern people.
Yeah, so you technically want to have a high, do you want a low bid to cover or you want a high?
No, you want a high bid to cover,
right?
Because that means you got a lot of orders. So we were at 2.63, now we're dropping below 2.5.
Got it. Yeah,
so that bid to cover ratio is dropping, and that's starting to.
And the reason I brought that up because I'm actually looking at here. You guys can see the most recent 10-year bond auctions, and you can see that it's 2.4 in July, 2.3 in August, 2.5 in September. So it looked like it was increasing, and now all of a sudden we're drifting down, and not looking very good. The good news is the yields went from 4.14 to 3.63 at that auction, but still putting some pressure on our markets going forward. And as the Fed continues to do what they say they're doing, which is unwind their balance sheets, right? They've said they're going to continue to unwind their balance sheet, which they should be doing, in my opinion. That puts further pressure to the south side on the bonds, right? Because you're seeing more supply come to market.
Well, just to remind folks, even though the Fed wasn't printing any new money since 2020, they've still been an active buyer of bonds because of all that interest that portfolio generates, and they were reinvesting it.
Right.
Now under tapering, they're not reinvesting that money; they're destroying it. So if you go back 3 auctions ago, the single largest buyer of the 10-year treasury was the Fed.
Yeah.
And now at the last auction, Fed wasn't there at all. They weren't buying any because they're destroying that money through tapering rather than reinvest it. So we've got the Fed participating less. We also have foreign central banks participating a lot less. So it is starting to create some concern.
I got a good question here, and I'm gonna answer it at least from my amateur knowledge of bonds and just kind of what my macroeconomic knowledge is, and then I'm gonna see if you can correct me, Professor. Trader Larry 1, he's a good question. He says, why would someone buy 10-year note when you can buy a 1-month T-bill for the same rate? And I think the reason would be that when you look at the rate of return, yes, you're getting a better rate of return for buying the 1 month. However, if you're looking at steady long-term, locking in a long-term rate, we don't know what that 1 month bond rate might be, right? Right now, it's been increasing. What will probably happen is that's going to start to get lower and lower and lower. And the person that bought the 10-year will have locked in at 4%. And the person that's going to get that 1 month, and let's say in 2 years down the road, is all of a sudden saying, man, I can only get 1% for my 1 month bond. I should have bought that 10-year and locked in 4%. And that's the way I would look at it, as a way for me to look at what I need as an income stream, and I'm locking it in for 10 years. Even though it's not as attractive, I'm still locking that in.
Perfect. And bond people, and perfect, Merlin, absolutely perfect. And what bond people refer to that is called rollover risk. Is let's say you want to put money aside by only buying the 1 year treasury, as you pointed out. The good news is you are getting a higher rate of interest than the longer maturity. The bad news is you're only getting it for 1 month. So at the end of a month, you're going to have to reinvest into another 1 month instrument, and another and another. And every time that treasury matures, the short one, you've got the risk of what have interest rates done over that period of time. And again, if rates continue to go up, you could make the argument, maybe you'd be better off doing that. Unfortunately, if rates go down, you might have been better off going out further. So if you want to eliminate that rollover risk, you might make the argument you're better off buying the longer maturity. If you feel, though, that you've got a path of rates that you think is going to continue to go up, you wouldn't want to do it that way.
Mm-hmm.
No, your observation is 100% correct. And then we just call that rollover risk.
Good. Obviously, and to Trader Larry's point, and he's commenting now, so good, I'm glad we helped you with that one. Yeah, if you just say, hey, I want to get that percentage rate of return for the next months, great, right? Then keep rolling over into those monthlies, but locking up long term. Some people need that to plan out their retirement and things like that, where you're setting a specific income amount, which I'm always an advocate for. So cool.
And you are also experiencing, everybody in this audience is experiencing rollover risk every day in their money market fund. Mm-hmm. Right? Your money market funds have very short maturities. They're constantly rolling over. And therefore, when short-term interest rates have been going up, you're going to benefit from that, like we've seen. But if short-term rates go down, you're going to get hurt just as, the same way.
Right. But that's also one of those things that's blind to people, right? Nobody, there's not one person here. I can guarantee this. I'll put any amount of money. I guarantee nobody is sitting there going, man, I wonder what the rollover risk tonight is on my money market funds.
Right,
shit.
exactly.
I'm biting my fingernails. You might be thinking about Tesla getting these huge margin calls today and tanking like I just free fall almost. But yeah, you're not worried about your money market fund rollover. It's just something that, it's built into it. We just accept that for what it is. And some people don't even know what happens.
Maybe I'm going to respectfully not disagree, but highlight. I'll bet you a lot of people in this audience have noticed that their money market funds has gone from 0 to 4%. Starting to earn something on cash. Starting to earn interest on cash now.
Sure. But they don't know the rollover aspect.
Yeah, yes. But I'm just saying that is an illustration of it. You're actually benefiting from that rollover risk.
Right. Yep.
Yeah.
Cool. Let's see. I think I got most of them. Why not buy 3-month T-bills at 4.3% yield and reinvest? Yeah, same thing, Big M. And again, you talk about the tax side of things. That's also another major consideration, right? Yeah. And then it's hard to make a statement that you should buy this one versus that one. You need to figure out what your situation is. Are you looking to save some money on your taxes as well and maybe get in a lower tax bracket? Fine. There's specific bonds you can buy for that. It's a complicated asset class here.
Well, and I also want to point out, though, and I'm not here to be a commercial for bonds, but I want to point out, for the last 2 years, I've been a bond guy since 1979. For the last 2 years, I have found no reason why anybody should buy a bond. If you're getting 2% interest and inflation's eating away your money at 6%, that doesn't make a heck of a lot of sense to me.
Except I-bonds. I think you would agree that I-bonds are probably the exception.
Floating rate's a different story. Yeah, right. Fixed rates. Absolutely. So for the entire pandemic, I've been educating, but I haven't been able to recommend in any way bonds. But if you think about even the questions you're getting, interest rates are starting to get up to a level where people are starting to pay attention a little bit.
Absolutely.
And on top of it, the credit spread, the premium you're now getting on corporates and junk bonds is higher than we've seen since pre-pandemic levels. So, we've forgotten about the traditional buy and hold bond investor, but they're starting to come back into the market. People who are looking at yields and saying this finally kind of starts making sense a little bit. Mm-hmm. And in fact, I'm going to put in a commercial. I'm doing an XLT on January 3rd. And that's what we're going to go back to talking about, bonds for income. For the last 2 years, we've been talking about bonds for trading. But now interest rates are starting to get to a higher level that they're starting to warrant some attention again. So we got to go back to bond basics again, buying them for income safety and let them mature. Forget about trading them. Let them mature.
Right. Well, you feel free to plug your XLT sessions. I'm all for it. I'm actually pushing and hoping we can get you a full, as bond class and maybe the focus series for you, because
we will. We're working on that.
To me, it's one of the more powerful asset classes. One other question for you. I know you follow the inversion of the yield curve, and unfortunately, I don't think I can share it with you here, but I have a chart. Okay. I have a chart of the 10-year versus the 1 year, and showing that the level of inversion there. And we were over we were over 1.25% inversion there.
We were.
Now, as you can see,
1.27. Yep.
Yeah, as you can see, the last 3 days we've had a pretty sharp rally up in the difference between those two. I'm looking historically, and this is probably the biggest inversion that I've seen, and it seems like it's staying a long time. Normally, when I've seen these inverted yield curves, it stays below. And by the way, for those who might be new and not know what we're looking at, this is the difference between the 10-year bond and the 1 year, and you can see in green, I have the 0 line. And basically, if the price is at that green line, that means that it's the same yield for both of them. If it's above that green line, that means that the 10-year is going to pay you more. If it's below, the 1 year is going to pay you more. And in this case, you could get almost 1% more for buying a 1 year bond versus the 10. And the trend, since I'm a big advocate of the trend is your friend to the bend at the end, this trend since 2021 has been nothing but down and aggressively down. So I guess my long-winded question for you is, does the magnitude of the inversion and the length of time of the inversion concern you?
Yes. And again, even to take another step back, because you do such a great job explaining things, that inverted yield curve that we're looking at today, which has been in place now here for the U.S. for 6 months now, although it's increased, as you said, to last week, we're more than 1.25. That's the most inverted yield curve we've had, once again, since guess what year? 1980 again.
Man.
Now, this inverted yield curve, just for the audience's benefit, has only happened 7 other times in U.S. history. So this is an aberration that is not normal. And as Merlin was saying, the inverted yield curve is predicting a recession. Well, actually, let me put it back. It's predicting deflation.
Right.
And what causes deflation is a recession. So when a yield curve goes inverted, like we now see in Germany this month, that is the market predicting a recession. And that's what the bond market has been predicting here for the US for 6 months.
Yep.
And now it's only happened 7 times, but there's growing, I'm going to say, analysis being done that the depth of the recession is also measured by the depth of the inversion.
Right.
2019, we had a little bit of an inversion right before the pandemic hit. And the truth is our recession wasn't really that bad, technically speaking. So there is growing collaboration that shows the depth of the recession and the depth of the inversion are correlated. But here's the problem. When I say depth of the recession, economists are having trouble even indicating that. Are we measuring it by time? Are we measuring it by velocity of GDP change? I mean, when I say the depth of the recession, there's a number of different ways you can measure it. But yeah, bottom line, the fact that this inversion is as bad as we've seen since 1980 lends people who are fearful like myself to get some justification to that fear.
Yeah. So for those of you that are watching the screen right now, and I apologize for those of you on the iTunes podcast, you don't get to see these charts, so go check them out at the TraderMerlin YouTube page. Really starting in August. So August, we're going to make it the exact date. We've had a couple dips down below it. You can see in March of 2019, we were below it for like a day or so. We fell below it in June as well for a couple of days and then bounced back up. But the real break was in August. That was the one that most people focused on. And we went to a maximum inversion of about 30 basis points. So 0.3% difference between the 1 year and the 10-year. And then, it was basically a month, right? It was a month that we were inverted and it ripped right back up and everything was fine. And okay, it wasn't that bad of a recession. And what I'm emphasizing here is for 6 months, not only have we not had any really bounces back to the upside, but it has just been getting more and more extended. So if you look out to the inversion that happened in the US markets, we have eclipsed the inversion that happened in 2019 in the first 2 days of the inversion. In the first 2 days was deeper than anything we saw in that over month that it was back in August. And now it's just getting progressively worse. So, I kind of hope that this bounces back up just from, a humanitarian perspective. But, if the trend is any indication, this thing, it just feels like it's going to keep on drifting. And I don't know what the bottom, possibility is. How deep of an inversion can you possibly get? I don't know.
Well, you look at the dynamics we've got going on. We've got the Fed committing to raising short-term interest rates, right? So they're going to take the short end of the market and continue to raise it. They told us.
Mm-hmm.
The real question is what's happening on the long end. And what you're really talking about is the volatility that we're now seeing is unprecedented because the marketplace is trying to determine exactly what you're saying, because we're at a threshold now. If inflation continues to be a problem that the Fed has to continue to taper, let's just look at that one variable. That is going to put huge upward pressure to long-term interest rates. The prospect of the inflation, the tapering. So interest rates are going up on that news. Conversely, though, if we get an economic number, like housing starts this morning, that's looking a little recessionary, that means rates are going to go down. And literally on an intraday basis, we're seeing volatility like we haven't seen before, 20 basis points in one day as the marketplace is questioning exactly what we're questioning here. We know what's going to happen in the short end.
Yeah.
Fed's going to raise. They own it. The real question is what's going to happen in the long end. And I have to say, the ultimate evolution of this, I firmly believe, is a recession. I mean, the fact that we're inverted, the punchline of this is a recession. The press loves to talk about the idea of a soft landing, that economic magical wonderland where the Fed can tighten but not hurt the economy too bad and result in a soft landing. That sounds great. So does a unicorn.
Yeah.
And I have just the same chance of seeing both. We're heading to a recession. That's what
I liked it. That was a fairly definitive answer there. I have quite a same probability of seeing both. That's good. In that yield curve, which I think is it's just one of my favorite charts to look at, the inversion. Does the Fed's unwinding of their balance sheet, as my mind thinks this through, the more that they unwind out of their portfolio, and again, if they got the 10 years, so I'm sure they got 10 years stacked in there. If they're selling a bunch of 10-year,
right.
Does that actually help the yield curve, right? Because if they're selling bonds and putting it in the marketplace, shouldn't that drop the yield, right?
Higher. Yes. No, absolutely. That's what I'm saying. And that's the whipsawing that's going to go on. So you're absolutely right. As the Fed needs to taper or tapers more, that puts upward pressure to long-term rates. If we're going into a recession, that puts downward pressure to rates. And this is literally the schizophrenia of number to number that the marketplace is enduring these days.
So the more the Fed unwinds, the more likely we'll get a yield curve that gets back to normal because they have to pay more for the long-term bonds because you're flooding the market with it. Unless demand surges, it's not going to. Interesting.
And they're going to have to sell bonds. Ultimately, they were the biggest buyer for years. They've got an $8 trillion portfolio now. But if they're really committed to tapering, that means they're going to have to start selling those bonds.
Yep.
So when your biggest buyer becomes your biggest seller or a big seller, what happens to prices?
Let's go back to another good analogy on this one. I don't know what the name of the movie is, but some of you may have seen this one. And I apologize, ladies. This is going to come across as very, very bad on my part, but it's my opinion. I think that the American population has been brainwashed into thinking that you have to buy the biggest diamond ring for your wife or fiance or girlfriend when you get married because that's how much you love them. If you travel around the world, they've got small, little, tiny diamonds. And De Beers and the other couple other companies did a masterful job of going out and doing great marketing. Oh, a diamond should be, 3 months of your salary if he really loves you. And what diamonds aren't that valuable. What De Beers has been doing is buying up all the diamonds, putting them in vaults and shelving them. So think about the bond market's the same way. If they're buying all the diamonds and putting them in a vault, but just leaking out a little bit, the price for the ones that are in circulation can be very expensive. Imagine what would happen if those vaults from De Beers were opened up and they just started selling all those diamonds. Your, 1 carat diamond that's worth $8,000 or $10,000 will be worth like $1 or $2 because they're flooded with the market. I think that's a similar analogy on how if you corner a market in something, it's much easier for you to manipulate it. But I think that the Fed's kind of pushed themselves into a corner, being the largest buyer of all these things. At some point, you're going to have to sell or unless ride them out to maturity, and therein lies the problem.
Exactly. And just to give it some scope, and I say this all too often, but the size is just so incredible. China and Japan together own about $2 trillion worth of our treasuries. And people have always heard for years, they're the big buyers. Together, they've got a little bit less than $2 trillion. Right now, our Fed owns over $8 trillion. They own 4 times as many as China and Japan put together. I mean, the amount of massive QE we did, they were buying $13 billion a day during the pandemic with money they just printed up. It was massive. It was like quantitative easing on steroids. I really believe that.
Oh, Ganesh says, what are the chances of a lost decade or deflation? So, I mean, there's no probability metric here, but I guess
Yeah.
if you could scope out the next few years, what would your vast experience in the bond market and just seeing these cycles, what would it tell you is the likely outcome of all this?
I think we're seeing, believe it or not, longer economic cycles, with the exception of the pandemic period. Coming out of the Great Recession, the period of growth we had was 9 years of growth, and the pandemic certainly skewed that. I mean, I hate being a forecaster, but I personally don't believe that inflation is under control yet. I really believe we're going to go back to levels we saw of interest rates, 4.5% on the 10-year for this cycle, because I don't think inflation has wrung itself out of the economy yet. But that being said, that's kind of the last gasp. And then we are going to go into a recession. And it's going to be a recession that was driven by the Fed. I mean, understand, they want to put us into a recession. This is not a threat. The Fed needs to not shut down. The Fed needs to quiet down the economy and the employment situation and the other factors. They want, they don't want to say it that way. They want us to go into a recession, and they're going to make it happen. So I think the end result is, then the question is how long, and that's crystal ball time, because I'm not trying to let myself off the hook, but we literally are in unprecedented territory here.
Yeah.
The Fed with a balance sheet this size, we have no idea what the impact of this is going to be.
And I would say I don't. You said, what about the lost decade? I don't think it'll be a lost decade. I think that these cycles have sped up. Certainly, that the length of these cycles have changed over time. And I think if you're a CMT and somebody that analyzes all of that stuff, yeah, you could probably say, oh, it typically lasts this long if this, this, and this. But that's the one thing I've learned more than anything in trading is everything works until it doesn't. You can have the perfect metrics, perfect indicator, perfect analysis, and all of a sudden it's working. Snap the fingers. And it's no longer working in any way, shape, or form. So, I think that more, instead of thinking, oh, it's going to be a lost decade, just start thinking of how will I position myself if these events start to present themselves. And if this happens, I'm going to do this. And be more reactionary, not even reactionary, but more anticipatory of how to play these different moves, whether it's up, down, or sideways. I saw a really interesting tweet from somebody who is very big in the financial markets. And he says, it's like, dude, you're telling me you don't trade, obviously. He says, these are the worst markets I've ever seen. And I said, they're only the worst markets because you're not making money. If he was making money, he'd be like, these markets are great. And I had to tweet back. I'm going, I'm actually having a very good year. And it's not to gloat. It's just saying, I've had my plan in place. I've executed on it, and I've been rewarded for that. And, if you're not making money in a down market, it tells me that you don't understand shorting. Or options or the different strategies out there to capitalize on it. And, we saw people lose 50% of their account in 2000. We saw people lose 50% of the account in 2009 or 2008. And it will happen over and over and over again. So markets are always great. It's just how you position yourselves with them.
And again, my bias coming from trading on the institutional side, trader's best friend is volatility.
Yep.
Trader's worst friend is a stagnant market. So no, I'm with you. The proven strategy and discipline. This is a trader's market.
Great question here from Pepe. It says, are CMTs successful traders? I always wonder that. CMT doesn't mean you're a trader. CMT means you understand all the different details and analytics about markets. You understand, Bollinger's and all these technical indicators. You understand market cycles. You understand seasonality. You understand sector rotation. You understand all this stuff. It's kind of like saying, if your broker says, hey, I have a Series 7, right? A Series 7 has nothing to do with trading. Anybody who says they have a Series 7 and it does not mean they're a trader. All it means is that Series 7 tells you what you can legally say to a customer without going to jail. That's what those licenses are for. What can you do before you start to violate what the SEC has put in place? So I look at these titles and they don't really mean that much. I think it does lend an air of credibility. For example, Scott McCormick. He's got his CMT, and if you listen to him in some of his sessions at OTA, guy's a genius, and he trades. So yeah, there are successful traders out there that have CMT designations. I'm sure there's some that are just looking for a title to put in their business card. Did you have to get any titles for bond markets?
Bonzar. No, we have licensing. The regulatory authority for the bond market is the PSA, Public Securities Association. So they have licenses and regulations that when I was as a managing director at Lehman and traders responsible to me, I had to get registered and licensed with the PSA, not a regulator that most people run across. But yeah, they're the regulatory authority for bonds.
Yeah, nice. All right, well, tell us a little bit about your, you have an upcoming session. You said January 3rd, XLT. Are you doing any other sessions for OTA?
Yeah, no, we just had one today, as a matter of fact.
Oh,
I'm
great.
talking about, this is my OTA day. So we had an XLT today where we talked about the TLT and the IEF and why these things trade and the volatility and duration. And we had a good class on that. And on January 3rd, we're going to do a class kind of going back again to the idea of bonds being used for income purposes, more passive income. The strategies like bond ladders and all the things we haven't been talking about for the last couple of years, because interest rates are getting more attractive. And I don't mean to sound sarcastic, but one of the beauties of a bond is, you're going to get your money back when the bond matures.
Right.
That's not a benefit you get from any other asset category. And we got to remember that feature. So we're going to get into kind of bonds 101, passive income, why bonds might make sense in this. So, and then the other thing is, and I've been threatening this now for the entire fourth quarter, is working with Larry, we do want to put together a focus series, a one-day bond class. Again, getting into the trading side of things. We did the 3-day signature series during the pandemic. Those are gone. And we're morphing into these focus series I'm sure people are aware of. So I would love to get one of those on the calendar, and it's all up to me. I just have to find the time to give Larry the outline, and let's do it. So I'm committed to the first quarter, getting a program for OTA.
I love it.
And it'll be virtual. It'll be virtual.
Looking forward to it. The more I can improve my knowledge of bonds, which I have to say, if I go back, how many years have I known you? It's been like 6 years or 6.
It's got to be 6 years. That was the number I was going to throw out.
I think it's like 6 or 7 years. For those who don't know, Bill came on and we recorded a bunch of series videos for him for the was it OTA Academy, which is a self-paced kind of content video site, which is now no longer there. And I learned so much, bond ladders and all these different structures. And I have to thank you, man. I feel like I've got my money's worth.
I've learned from you too. And I got to say, you're a professional, and your client, your audience out here, they ask great questions. I enjoyed this program. You guys are much more fun than my institutional clients. I say that every time.
They've got more money, but we're a little more exciting.
There you go. And I agree with that. So no, it's been a pleasure. I enjoyed it. It's been a great 6 years. We'll do more.
Absolutely.
Do more next year.
And if you want, you can go to aftraining.co. I will put that link in the chat here for anybody who might be interested in. He's also got some YouTube videos he's putting out. There is a shop here, and he's got 3 books.
The book deal goes on.
Book deal goes on. There's an equities book, fixed income, and derivatives. You can get the bundle pack for $25 if you click on that link there. So, help support a cause. Give a little extra couple of bucks for Bill's hard work and efforts out there.
Stu did a great job. The author of that is Stuart Beal, and he did a great job. I had a chance to edit it, so glad to pass these on. They're really good and basic introductory books. So thank you, Merlin.
Wow, my pleasure.
It's a pleasure these 6 years. It really has.
Yeah, looking to many, many more. All right, Bill. Well, hey, thank you very much. We're into the tail end of the year, so I wish you and your family a very happy holiday. I hope that you guys do something fun. I'm sure you're going to be traveling and spending time with... I was going to say goodbye, but GD is insisting to ask the question here, so let me ask one more question. But I'll give you the holiday.
Go ahead.
GD says, we're trying to quell inflation, so can Bill explain why we also don't want deflation?
Well, actually, I wouldn't say we don't want deflation. The Fed has set a target of 2.5%. Well, actually 2%. We're kind of floating 2.5%, and many people feel the Fed target will be 3% by the next meeting, just as an FYI. Mm-hmm. But we do need deflation to get inflation down from the 8%, 7.7, where it is now. So, again, I keep stressing we want some inflation. We just don't want too much. And if we had to go through a deflationary period to get that, I don't mind. The market doesn't mind.
Yeah, I think it's when you think of health, when you think of going through sickness, right? You get sick, your body, your whole immune system has to fight off that infection. As a cold I'm going through right now, it fights that off, and in theory, your body's going to build some improvements against that infection or that virus or whatever it may be. So the next time you get it, it's not going to be as bad, but you're still going to have to go through the ups and downs, being healthy and being sick. That's just the nature of being human, and I think that our markets are a reflection of that. Markets are going to be healthy for a long time. They're going to be sick, and hopefully we learn from that. Is a deflationary market a bad thing? I think it can be, depending on how prolonged it is and the magnitude, but it's just a part of the process. And again, don't look at it as a good thing or a bad thing. It's how are you going to position yourself to capitalize on it from a financial perspective. I think that's the goal of this show.
Couldn't agree more. Couldn't agree more. Well said.
All right, Bill. Well, thank you very much again. I hope you and your family have a fantastic holiday, whichever you celebrate. If you celebrate nothing, then, I'll still raise a beer in your honor and cheers you on this holiday season.
I'm a Christmas guy, but happy holidays to everybody, and take care of yourself. Feel better. Take some rest. You had a tough week here.
I've been taking rest. I'm good. But thank you very much, my friend. I'll talk to you in the new year. Take care.
Be well. Happy New Year to everybody. Thank you, Merlin. Be well.
You too.
Cheers.
I got those. Bill Addiss of AFTTrading.co. He's also teaches some classes for Online Trading Academy. I would encourage you to check those ones out. He mentioned January 3rd is his next XLT session. Always great information, and I swear I learn every single time that guy's on the program. We didn't even get through all of his charts. He had some cool stuff here he wanted to talk about. We didn't really get into what happened with Jerome Powell and the FOMC last week, but we pretty much covered that, you and I, without Bill Addiss. So anyway, thank you guys so much. Hope you enjoyed that one. I didn't really look at these markets, so let me do that real quick before we wrap up, and then I can go rest my throat, which is going to be sore because I've got a class tomorrow morning. Or what's today? Tis Tuesday? I got a class tonight. I got a presentation tomorrow morning and a class on Thursday, so it's going to be a long day for me, long week. All right, let's go into our overall markets. It was not the prettiest picture out there, and we're drifting down a little bit in the after hours right now. Here is your NASDAQ. Let me zoom in here. I feel like we are definitely due for a bounce based off of what I'm seeing on this, aggressive 5-day slide here. Somebody actually emailed me earlier asking if this was a hammer formation, and I personally don't think that I would call the NASDAQ futures right now a hammer formation. It's more of a doji where you have the opening and closing price right around the same. So not a real interesting chart there. NASDAQ down about 0.16%. S&P was actually up ever so slightly, 0.1% gain. And, again, I don't know which way this is going to go, but it just feels like when you have such an aggressive slide that it gets a little bit overdone, and then we might see a little bit of a hook up here. Now, I also like to look at the volume on this one. If we had a large volume spike today, I'd feel much more confident about a bounce tomorrow. I just don't see it. Let me get that volume off there and move up the ladder here. So the Dow was up 0.24% today in a much more compressed range compared to some of the other indexes. The shining star from the indexes, though, Russell, 0.52% up for the Russell, which showed a nice green body there on today's candle. Crude oil showing some nice moves up. It's almost the exact opposite of what we saw with the equity indexes. 0.13% move up. It gapped up overnight and then are on the rollover and has been just moving up ever since. And let's see, we got gold and silver both looking great today. I sold some more put options on silver yesterday. So I sold a bunch of silver options. And lastly, Bitcoin, 2.09%. But really, when you look at what's been happening over the past few months, Bitcoin is just not as exciting as it used to be. Hopefully that will change at some point in the near future. GD, have you been doing your push-ups? I have not. I have not been doing my push-ups. I have been doing no exercising. I'm just literally, I hate it. Being sick is one thing, but knowing that I can't go do what I normally like to do, which is I like to go to the gym, I like to exercise, I like to go work out and be social. Well, A, I don't want to go out and infect anybody by, giving them the flu. That would just be inconsiderate and selfish of me. And B, I don't want to strain myself and work out. So I'm like dying here because I just sit and watch trash TV, although my dog loves the fact that I'm home on a regular basis. So I did not bring up your economic calendar for tomorrow, but I will do that right now. Not a lot of major stuff. There's a couple for the U.S. You have existing home sales coming out at 7 a.m. That is going to be Pacific time, which means 30 minutes into the trading session. You also have consumer confidence. And then Canada. I guess that's the big red factories over here. I tell you, that's the important one. So Canada comes out with their CPI numbers, expecting to see a significant decline, which I thought was actually rather interesting here. Previous month over month for CPI for Canada was 0.7%. They're expecting it to drop to 0, meaning no increase month over month with regards to inflation, which would be a pretty darn good thing if people are actually expecting it to start to slow down and move back to the south side. Well, Gary, I didn't do the push-up challenge for December. I did it for November. December has been pretty mute. I'll get back into it as soon as I'm back and healthy. I got a lot of catching up to do. But all right, let's see. There's always Scooby-Doo. What have I been watching? I've been watching some pretty bad stuff. Although the good news is Jack Ryan. I'm a big fan of the Jack Ryan series. That actually comes out today. I think it's tomorrow, the 21st. Jack Ryan show comes out. I watched Wednesday. The Addams Family thing. But it was like a Hardy Boys kind of mystery movie, but based with the Addams Family. Whatever. It's not that great. I just don't really like watching that much TV. There's so much other stuff to do in life than sit in front of a tube and watch somebody else entertain you. Get out there and entertain yourselves and do something with your lives. All right, that's going to do it for me. I didn't plan on doing a full hour show today as my energy is not what it should be. I don't have a guest the remainder of the week. I had a couple people ask me if they could come on, but again, I don't want to bring people on here who are salespeople and are really pitching you stuff. I'd rather you get some content and education. So I have told them kindly, sorry, you can't come on the program. But I will see if I can get other people on that might give you some education, help you learn about these markets more. The Avatar movie looks exactly the same. It looks literally the exact same as Avatar 1, just underwater. Yes, I do like the rock and rolls. The Niners, yeah, baby. Clinch the playoffs. I'm loving that. Oh, man. Here we go. All right. I'm going to wrap things up. So thank you guys so much. If you have comments, questions, feedback, things you want me to talk about, give me a show topic for the rest of the week so I can sit on the couch and come up with something. Let me know. You can post anything down below the YouTube video. Say, hey, do a show on this, that, or the other thing. I'd be happy to do it. Just pick any YouTube video, comment down below it, and I will include those into the slides here and maybe make those show topics. Or you can email me at TraderMerlin@gmail.com. That said, everybody, have a fantastic remainder of your day. I will see y'all tomorrow. Take care.